So you've probably seen all the headlines lately. Stock prices are too high. They're overinflated. Everything's going to crash. PE ratios are too high. This is not sustainable. The bull run can't continue. We're headed for a bear market, which is a correction or a crash of 20% or more from the peak of an index. And realistically, the best advice to survive a bear market is to just stay the course. Just keep doing what you're doing. Keep dollar cost averaging, hold, don't panic sell. But that's not what you came here for, right? You didn't click on this video for me to just tell you to do nothing. You want an actual tangible strategy for how to position your portfolio for an incoming bear market if we're heading towards a bear market. So I'm going to talk about that today, even though I truly think you should have an investment strategy that works well in good times and bad. Now, with that out of the way, like I said, a bear market is a 20% drop. So let's say the S&P 500, which is the 500 largest companies in the US, let's say that drops 21% from its peak. That's officially a bear market for the S&P. Different indices will have different performance, so a bear market is a bit of a broad term. But essentially, it's a stock market downturn, right? If you have $100,000, you suddenly have $80,000. That's not great. Nobody loves to see that. The best thing to do is to reposition your mentality. So let's say you go to the grocery store every single week and you like to buy Cheerios cereal. You buy it every single week. That's what you eat for breakfast. Let's say Cheerios cereal is normally $5 every time you go to the grocery store. One day you go to the grocery store and it's suddenly $4. Do you freak out and run out of the store and say, I'm never buying Cheerios again? No, you would buy more Cheerios maybe. You would stock up on Cheerios for when it goes back to being $5. The stock market is the only time when people run away from a discount, when people run away from a sale. If something was on sale, normally that's when you want to be buying, but investors have such weird psychology that they end up selling when they should be buying. So the first thing is just don't panic sell and reframe your mindset that this is a discount. If you're owning quality companies, then a stock market dip is a great thing because you can buy quality companies for a cheaper price than you could before. It's great. Now that's easy to say, but I think it's important to understand what actually causes a bear market, and there's quite a few things that could really cause it. So the first is naturally an economic downturn, and that's quite broad, but things that could contribute to an economic downturn are rising unemployment, a decrease in consumer spending, and a decrease in corporate earnings. So let's talk about the first one because I think a lot of people are worried that AI and the Department of Government Efficiency might lead to an increased level of unemployment, right? People might get laid off because their jobs are being automated by robotic process automation maybe. And I think until we actually see the numbers, it's just speculation at this point, but it is a possibility. Consumer spending, consumers are still strong. If we look at this article from US Bank, we have the Chief Investment Officer for US Bank Asset Management saying consumers are in a good spot right now. And this article was just posted this past week in March of 2025 when I'm recording this. So we don't necessarily have consumer spending decline yet. However, we do have consumer confidence sinking. So this article from Morningstar says consumer confidence sinks to 4-year low and it's no secret why. Trump, tariffs, and trade wars. So all consumer confidence it means is it's consumers, so people like you and me who buy things, it's their expectations for the economy. So people like us are saying we don't think the economy is going to be doing very well. Sometimes expectations of something can cause the thing, right? If everybody panics about the economy, it can lead to a poor economy. If everybody panics about the market, it can lead to a poor market. Just think, everybody starts selling because, oh, there's going to be a crash incoming. The people who are selling just caused the crash that they were worried about. It's completely counterintuitive. But that's one thing that can cause a bear market. You can also have things like high interest rates, right? Because when interest rates are high, it makes it much harder for consumers and for businesses to borrow. So let's say you have a growth company that is funding its operations through debt. It might have to take on debt at higher interest rates, which eats into profits. Let's say you have a car company, right, which automobiles, especially in the US, are typically financed. They're purchased with debt. If interest rates are high, consumers aren't going to be buying cars as much. So that's going to impact car companies, which is going to impact steel companies, which is going to impact, it's a trickle-down effect. We also have things like high inflation that can lead to a bear market. So when inflation is high, that erodes your purchasing power. If you had $1 in 2020 and you have $1 now, it's not going to be worth as much as it was in 2020. That's because prices were much lower in 2020 than they are now in 2025. Those types of things eat into company profits, they eat into consumer spending, and it can cause a bear market. You also have things like geopolitical events, wars, trade wars, which we might be heading into depending on who you ask. And there's also things like black swan events. So a black swan event is essentially something that's unpredictable, but severe. So think the 2008 financial crisis, right? The housing crisis that you could have maybe predicted in hindsight, but nobody truly expected it to happen in the moment. So we actually just had a bear market 3 years ago in 2022. And I think it's worth looking into what caused that bear market so that we can learn from that and see if we're heading towards a bear market today. So in 2022, one of the big things we had was rising inflation and high interest rates. We kind of had that combination of those two bad things that cause bear markets working together to cause a bear market. So rising inflation, I think you could blame mostly on the black swan event that happened with the virus, right? And the stimulus checks that were given out by the government, right? That put a whole bunch of new money into the economy, which drove up prices very rapidly. When prices go up very rapidly, the Fed, or the Federal Reserve, steps in to raise interest rates in order to curb inflation. It wasn't very effective. Inflation kept going, so we had high inflation, high interest rates, bear market. It's bad. However, it wasn't just that. We also had lingering supply chain issues from those virus times, a war in Ukraine and Russia, and we had very high energy prices. Energy prices had been going up and up. I remember that, seeing my bill and being very concerned about my energy prices because I'd used less energy, but my bill was higher. So as you can see, there are a lot of things that can cause a bear market. It's not just a formula. So are we heading into a bear market right now? Literally nobody knows. It's impossible to predict. However, you do want to be prepared for it just in case it happens, but you don't want to bet on it, if that makes sense. A few things that might be pointing towards a bear market would be obviously the uncertainty surrounding new tariffs. So I'll point to this article here from Morningstar. Tariffs aren't the true cause of the market sell-off, and I agree with that. The tariffs aren't a surprise. The US president talked about tariffs. They were a big selling point of his campaign. We knew tariffs were coming. The reason for the sell-off is the uncertainty. The market really does not like uncertainty. So when things are business as usual, the stock market goes up. When we throw a wrench in the works and something unexpected comes into play, like the virus or the 2008 financial crisis, markets go down, down, down because it's unprecedented times. Nobody knows what to do. They panic sell. So it's not necessarily the tariffs that have caused the sell-off, it's the uncertainty surrounding the tariffs, surrounding what kind of economic impact this will have, surrounding how much the tariffs will be. I mean, news around the tariffs changes every single day. So I think we need to keep in mind that we have a lot of uncertainty right now about the future impact on the economy. However, something pointing to the bull market continuing is that fundamentals for companies and for consumers are still quite strong. You still have a very strong consumer, and yes, that's weakening and their confidence is shrinking. However, companies are still flush with cash and interest rates may be coming down. So we have those ingredients that sort of point to a bull market, and we have ingredients that point to a bear market. So you really want to be prepared for both. So let's talk about the bear market first. So what types of stocks do well in a bear market, right? Because there are stocks that actually do better when the market's in a bear market. And those are things in the defensive industries. And so defensive sectors are things like consumer staples, utilities, and healthcare. The thing that these three sectors have in common is that these are businesses that don't change when the economy's bad. You still have to keep your lights on in your house when the economy's bad. Utility companies are going to be okay. You still have to buy toilet paper and toothpaste when the economy is bad. Consumer staple stocks are going to do okay. And if you're sick, you're still probably going to go to the hospital when the economy's bad. Healthcare, going to do okay. So those are the types of things that typically you are going to see outperform in a bear market. The things that are going to underperform are the opposite. These are the very cyclical things. These are the risk-on sectors. So think things like tech, industrials, where you're building out machinery, consumer discretionary, like things like new cars, clothing. Those types of things are not going to do well in a bear market. You also have stocks with high PE ratios. So think your high-flying growth stocks. So things like Tesla, Palantir, the things that everybody's excited about, those are not going to do as well in a bear market because everyone was excited about them and maybe things got a little ahead of themselves. People are going to suddenly start selling off because they're worried. That's not to say that those aren't good companies to hold for the long term, but maybe in the short term they might underperform if we have a bear market. All right, so that's what does well in a bear market and what does not so well in a bear market. The best thing is to be diversified, right? So if you have a portfolio that contains all the different stock sectors, they don't have to be equally weighted, but if you have a little bit of exposure to each sector, you should do better than somebody who's all in on tech, right? If somebody's all in on tech, they're going to outperform in the bull market because those are the types of things that people want in a bull market, the risk on stocks like the Palantirs of the world. But in a bear market, People are going to like those really boring stocks. You're talking dividend companies that have a very long track record, that have been around for a long time. Things like Coca-Cola or things like Procter & Gamble, where they have this strong history of being around for a long time and being a product that doesn't require lots of R&D or isn't too reliant on geopolitical events. You're still going to buy toothpaste. You're still going to buy toilet paper. You're still going to buy snacks. These types of companies are going to do well in a bear market. So if you have a little bit of exposure to the boring companies along with the exciting companies, you should be just fine. It's also important to consider the aspect of risk tolerance and risk management. So if you are somebody who is younger, maybe it makes sense to take on a bit more risk, right? Because let's say you're in your 20s, you probably have a good 30, maybe 40 years before you have to sell your stocks. You can afford to be in maybe more aggressive stocks. That's not to say you should invest in risky stocks and speculate, but maybe you can take on a bit more risk for potentially higher reward down the road. If you are maybe in your 50s, 60s even, you probably shouldn't have a big exposure to stocks because hopefully you'll be retiring soon and you will be wanting to sell some of those stocks. And the worst thing is to sell stocks in a downturn. However, let's say you're in your 20s, but you don't like seeing your portfolio go down. You don't mind if it goes up, but as soon as it starts going down, you freak out, you lose sleep, you hyperventilate. That might be a sign that you have a lower risk tolerance. And if that's the case, there's no shame in taking a safer approach to investing, even if you're young. Let's say you are in your 20s and your friends are all 100% stocks. It's okay to be 50% stocks and have some money in cash or in bonds or in safer investments or in gold or in real estate. You don't have to always be in aggressive tech stocks just because you're young. I know, it's crazy, mind-blowing, right? And then also consider position sizing. It can be very tempting to go all in on a great stock that's down. However, you need to keep in mind that that's a very risky thing to do, right? So let's say all of a sudden Palantir drops 50%. Maybe you want to go all in on Palantir and have it as 100% of your portfolio because it's on sale. Well, what happens if Palantir drops another 25%? Your entire portfolio has just dropped 25%. So that's a very risky thing to do, and it's not advised. So if you are going to double down on some of your favorite stocks, make sure you set a rule for position sizing. So say, no position in my portfolio is going to be greater than 10% or 15% of my portfolio. That way you kind of shield your company-specific risk a little bit. Finally, if you do believe that a bear market is coming, it's very important to have some cash on the sidelines because the worst thing to happen is a bear market comes and goes and you didn't buy the dip, right? So nobody can predict the bottom, so don't you dare try to time the bottom. That is the worst thing you can do. It's so stupid. I hate when people say, oh, I'm waiting for the bottom before I put. No, shut up. You do not know when the bottom is going to happen. Nobody knows. If a single person knew when the bottom was going to happen, everybody would know. And everybody, no, it's just no. You're not going to wait for the bottom. You're not going to get the bottom. Dollar cost average when you feel like it's appropriate. So if the market does drop 20% from its peak, maybe start putting a little bit of cash in each week. And then as soon as the market starts to recover, you'll be glad that you bought that dip. Don't wait for the bottom. That is just not a good idea. You're not going to catch the bottom. You're probably going to miss it, or you're going to go all in way too early and it's going to keep dipping. Just don't try to time anything. I promise. It's not a good idea. And managing cash. So like I said, you're going to want to have some cash on the sidelines. And since interest rates are still pretty high, you can always put that cash into what's called a money market fund or a high yield savings account, something that is cash but still earns interest. What you want to make sure is that this is a essentially risk-free investment. So what I use is a government money market fund. So it is backed by the US government. What you can also do is something that's insured by the FDIC, which is the Federal Deposit Insurance Corporation, and they will insure your deposits up to a certain amount. So it's a good idea to keep cash in something that earns interest, and as time goes on, maybe start to put a little bit of that cash back into the market, into quality companies that are beaten down. And if you're not sure what those companies are, that's where you get to research, or you can just go into index funds. Broad market index funds are a great idea if you're not so keen on analyzing individual stocks. I love analyzing individual stocks, so if you like that, subscribe to the channel. I do that kind of thing. And finally, one of my favorite things is if you're worried about a bear market and you don't like seeing your portfolio go down, just don't look at the news. Don't look at your portfolio. If you have, let's say, 10, 20, 30 years till retirement, the current events and news that are happening today do not have an impact on your future. So realistically, let's say you've already bought the dip, you don't have any more cash, just uninstall your brokerage account, uninstall your watch list app, uninstall your news apps, learn a new hobby, maybe learn guitar, maybe learn Spanish. maybe go for a walk in the woods, and just disconnect and tune out the noise, because the more you read those headlines, the more worried you're going to be, the more you're going to make irrational decisions. And irrationality is the worst thing for your portfolio. So don't freak out, just disconnect for a little bit and maybe have a nice cup of tea, and it's going to be fine. These things come and go. Bear markets come and go, bull markets come and go. It's going to be okay. And if you just can't let go and you need to do something, it's a good time to check in on your portfolio and make sure that all the stocks that you're holding are stocks that you are comfortable with, right? You don't want to have any speculative things in your portfolio or something that you just bought because a friend told you to buy. You want to have high conviction on all the stocks in your portfolio during a bear market. So maybe you can trim some of the excess that you don't have high conviction on and double down on things that you do have high conviction on. I actually made a video about how to clean up your portfolio, so maybe it's a good time to rewatch that and see if there's any cleanup that you can do in your portfolio. And at the end of the day, like I said at the beginning of the video, the best thing is to just stay the course. Just keep doing what you're doing, because your strategy should work in good times and bad. I hope that this was a bit of reassurance and a bit of education. Also, there's a fun fact. Did you know that the reason it's called a bear market is because when a bear strikes or attacks, it goes down with its claws, right? It slashes downwards with its claws. And when a bull attacks or strikes, it slashes upwards with its horns. So when the market is going upwards, it's a bull market. When the market's going downwards, it's a bear market. In case you've ever wondered why those terms came to be. If you enjoyed this video, please hit the like button. It really does help with the YouTube algorithm to start spreading this video to other people who might need to hear some investing tips and tricks. And if you are new here, please subscribe. Like I said, I post stock videos, but I also post general investing videos. And if that's your cup of tea, I would love to have you as a subscriber. Thanks so much for watching the video, and have an amazing day, and don't panic sell.